On a crisp Tuesday morning in a western suburb of Melbourne, two tradesmen who had worked side by side for 34 years sat down in the exact same smoko shed to check their final super balances. Their names were Mark and Steve. They had started on the exact same site on the same morning in 1992. They earned the exact same hourly rate, paid the exact same tax, and had identical employer contributions deposited into their accounts month after month, decade after decade. Contributions that started at just 3% back in the early 90s and slowly climbed to over 11% today. When Steve logged into his portal, his account balance read $410,000. When Mark logged into his, the screen read $780,000, a difference of $370,000. Neither of them had gambled on speculative stocks. Neither had tried to time the market. They had simply filled out a single sheet of paper on their first day on the job in 1992 and never looked at it again. Steve had ticked a default, conservative retail fund pushed by a major commercial bank. Mark had been assigned a profit for member industry super fund through his trade union. That single, forgotten checkbox cost Steve $370,000 of his life's work. Australia's superannuation system is often celebrated as a global financial miracle. Trillions of dollars sitting in collective wealth, growing quietly in the background, while millions of workers go about their daily lives. But behind the glossy TV commercials lies a cold, mathematical reality. There is no single magic fund that hands out guaranteed wealth to everyone who joins. Instead, there is a brutal compound machine where tiny differences in fees, asset allocation, and ownership structure compound into life-changing amounts over 30 years. To understand why Steve ended up $370,000 behind Mark, you have to look at where the money actually goes. For decades, the system was divided into two distinct worlds. Steve's retail fund was created by commercial wealth managers and big banks. Their business model was straightforward: take member contributions, invest them, and slice off a steady percentage of the total pool to pay profits to corporate shareholders. Mark's industry fund operated on a non-profit trust model. Every dollar earned after baseline operating costs went straight back into member balances. On paper, paying a 1.5% combined fee on a retail account sounds harmless. It sounds like the price of a coffee every few weeks. But in the math of long-term compounding, that fee drag is devastating. If an account earns 8% a year on average, but charges 1.5% in management and administration fees, the net growth rate drops to 6.5%. Over a 40-year career, that 1.5% fee drag doesn't take away 1.5% of your final balance. It devours more than 40% of your total potential wealth. Steve worked 4 decades on site, but gave up close to 17 years of his retirement returns. Nearly half his working life handed over to a corporate balance sheet. Massive regulatory pressure over the past decade forced a wave of consolidation. Dozens of underperforming retail funds were forced to merge or shut down after failing government performance tests. Smaller funds couldn't compete with the sheer scale of modern mega funds like Australian Super, Australian Retirement Trust, Aware Super, and Host Plus. Scale meant leverage. It meant buying direct stakes in major international airports and energy grids at wholesale prices that retail investors could never touch. Yet as these funds grew into multi-billion-dollar entities, a new tension emerged. When a single fund manages hundreds of billions of dollars, its scale keeps baseline administration fees extremely low. But moving that much money is like maneuvering an oil tanker. It cannot easily pivot into smaller, rapid growth opportunities without moving entire markets against itself. During market crashes, like the 2008 financial crisis, Steve watched his retail fund balance drop off a cliff, while high fees continued to drain what was left. Mark's industry fund took a hit too, but its massive scale and low overhead allowed it to absorb the shock, keep fees low, and buy up cheap assets at the bottom of the market. When the recovery came, Mark's balance rocketed upward, while Steve spent years just trying to get back to where he started. This structural performance gap fueled a major shift toward low-cost index investing. Options like Host Plus Indexed Balanced or Vanguard Super. Instead of paying team managers high salaries to handpick stocks, indexed super options strip out human stock pickers entirely. They use automated structures to track whole market indices, buying every major listed company in Australia and across the globe. The result is a sharp reduction in cost. While standard managed options charge around 0.7 or 0.8% annually, indexed options can drop total fees below 0.2%. An actively managed fund has to beat the market by at least 0.6% every single year, just to break even with a low-cost index option, after accounting for higher fee hurdles. Decades of data show that very few active fund managers achieve that consistently over a 30-year time frame. This is why looking for the best super fund is a flawed search. It's like asking what the best vehicle is. A heavy-duty four-wheel drive is the right tool if you're hauling timber up a muddy mountain track. But if you put that same four-wheel drive onto a race circuit, it will get lapped.
The right super fund depends entirely on what job you need it to do at your specific age. Think about where Mark and Steve were at 18, starting on their very first site back in 1992, both ticking forms by default without realizing the 40-year cost. Their biggest financial advantage back then wasn't their opening balance, it was time. They had over 40 years of compounding ahead of them before touching a single dollar of super. For an 18-year-old today, sitting in a default balanced option, which holds 20 to 30% of its assets in low-yield cash and government bonds, is a slow growth bottleneck. Bonds provide short-term stability, but over 40 years, that safety eats potential growth. A young worker who switches their investment option to a high growth or international shares allocation takes on higher short-term swings. Their balance will drop during market downturns, but because they don't need the money for 4 decades, short-term drops are irrelevant. What matters is maximum long-term growth. Now look at Steve at 62, 18 months away from putting down his tools for good. For Steve today, a major market crash would be catastrophic. He doesn't have 20 years to wait for a market recovery. He needs capital protection, steady income generation, and low account fees. Steve spent his 20s and 30s sitting in a conservative default retail fund when he needed aggressive growth. Then, as he approached retirement, he remained in that same option without adjusting his risk. He had the wrong vehicle on the track for 34 years. Beyond fees and asset choices, 2 quiet leaks drained Steve's balance over his working life. When Steve opened his bank super account back in 1992, he was automatically enrolled in default life and disability insurance. Because he never checked his statements, he paid monthly premiums for 34 years on policy coverage he never tailored or reviewed. Mark had checked his statement in his first year, realized his union already provided cover on site, and cancelled the duplicate policy, keeping thousands of extra dollars inside his account to compound over time. Then came the multiple account trap. When Steve switched subcontractors in the late 90s, his new boss opened a second super account for him. For nearly 6 years, Steve was paying 2 separate sets of flat monthly administration fees, effectively paying double subscriptions for the same basic service, until those lost accounts were eventually consolidated. That delay alone drained tens of thousands of dollars in compounding power out of his final balance. Mark and Steve did the same heavy lifting for 34 years. They put in the same hours, took the same physical toll, and paid the same dues. Mark didn't end up with $780,000 because he was a financial genius. He ended up $370,000 ahead because he took 10 minutes on his first day to pick a low-cost, member-focused structure, eliminated unnecessary fees, and let compounding run uninterrupted. If you haven't reviewed your super account in the last 12 months, take 10 minutes today to check your setup through your MyGov portal or directly at ato.gov.au/yoursuper. Check 3 things immediately. 1 thing, your total annual fees. Ensure your combined management and admin fees aren't quietly eating into your growth. 2nd thing, your 10-year net performance. Compare your fund's long-term returns against low-cost industry benchmarks. Last thing, your investment option and insurance. Make sure your asset allocation matches your age and cancel duplicate insurance policies you don't need. 10 minutes on a portal today is the difference between retiring on your own terms or leaving $370,000 sitting on the table. Leave a comment below. When did you last check your total annual fee percentage
And did the number surprise you? Hit subscribe for more clear, independent breakdowns on real wealth.